Okay, welcome to our third advanced training of the year. Gary and I have done one of these earlier in the year, or two of these, I'm sorry, and we're pleased to be joined today by Scott Macbeth, the Master Options Trader. Scott and Gary, you guys want to say hi real quick?
Gary's there. Scott's here.
Scott's here.
Hey, good afternoon, everybody. Welcome on board.
Okay, Gary, you're sounding kind of tinny. We got a lot of material to cover today, guys, so we're going to go pretty quick, but we're very, very excited about today's program. We've spent quite a bit of time the past 2 weeks working on this, and we actually had to stop talking to each other yesterday because the more we worked on this, the more ideas we came up with, and we knew that people didn't want to sit here for 6 hours, although we've got that much information we could offer. So we're going to go through this pretty quick. Don't get concerned if you feel like you're not keeping up, because everyone will receive the recording of this. We will automatically mail those. You don't need to call the office and ask for it. Anyone who is registered for this, even if they weren't able to attend today, will get a copy of the recording. So our topic today is profitable earning moves. Now, we know that these earnings moves using Best Choice have been extremely profitable for a lot of people. And with some of the new additions and updates to Best Choice that we've had over the past year or so, we've been able to sort of refine finding these earnings moves and how to trade them. And so Gary and I are going to cover finding these earnings moves and how to trade them. And I'm very excited that Scott's going to be talking about trading psychology and money management, because those are the two areas that as I'm working with people, that I see people have the most trouble with. We do a pretty good job training people how to use Best Choice, how to find these seasonal trades, but people still tend to struggle with getting in their positions, staying in too long, or getting out too early, or not being able to pull the trigger. And so Scott's going to cover trading psychology, how to go into your trades confidently. And he's also going to talk about money management, not taking too much risk, trading according to your own risk profile. So we've got a lot of material to cover today. I'm going to go ahead and get started. We've got to go through a few disclaimer things here first. And this first one is just a standard risk disclosure. If you're trading in the market, whether you're trading stocks, options, futures, whatever, I just want to point out that none of us are licensed brokers. We're not here to give you trading advice. This is for education. We want to teach you how to find these trades. We want to teach you how to manage your money, but we're not here to give you trading advice or tips on particular moves coming up. The main thing at the bottom here: Best Choice Software, its instructors, or mentors may not provide trading or other advice regarding the purchase or sale of any futures, options, or other financial product or service. So I always use the adage, I would rather teach a man to fish than give him a fish. And so that's what we're here to do today, is teach you how to fish. Now we're going to be talking about some third-party websites, third-party platforms, different ways that we use charting and so forth. Any reference to third-party websites, software programs, platforms, or brokers is not meant to be an endorsement or recommendation of that particular third party. It's only the particular site that we tend to use. There's a lot of sites out there that can provide the same type of information. However, we do try to use websites and platforms that anyone can use for free, and you don't have to necessarily sign up for them. So there's lots of different places. The sites we're going to use today aren't necessarily the only ones. And then finally, and I think most important of the disclaimers, all of this material that we're making the video with today is the property of Best Choice Software. It's not allowed to be duplicated, referenced, or summarized without the written permission of Best Choice. Okay. One more slide here, and then we're going to get to the meat. Webinar etiquette. These are just a few tips that I always go through when we start a webinar. First of all the attendees will remain muted. We can't hear you, so don't be talking to us. We will not be taking questions today. We simply have too much material to go through to have a question and answer period at the end. So you can type away in the question box, but we're not going to be watching that, so we won't be answering any questions. Screensaver and audio problems. If we get about 30 minutes into the presentation and your screen goes blank, it's not on our end. It's probably your screensaver. Just wiggle your mouse around and your picture will come back. Now, if you have audio problems, sometimes everything sounds like there's an echo. Try hanging up and dialing back in to the conference call number. Usually when that happens, you just got a bad phone connection, phone line, and dialing back in will usually solve that. We're not going to be going over any basic training today or any of the training we've done in the previous advanced sessions. So as we're doing searches and so forth, or compiling lists or intersecting lists, if you're not sure what we're doing or you've never seen something done that we're doing, probably you haven't been through our basic training, or this is your first advanced training that you've been to, and it's probably something that we covered in one of the previous sessions. If you have not been through the basic training, just get hold of whichever coach is assigned to you, and they'll be happy to help you with the basic training. Also, our 2 previous sessions were also recorded, and those are available through the office. We're going to be taking a couple of breaks today since there's 3 of us. Our goal here is to take a break after each presentation. And so we'll be taking 2 breaks instead of 1 today. And our basic agenda today, at the end of each one of our presentations, we want to have a little bit of interaction between the 3 of us. Anything that maybe one of us left out, or any ideas that came up while we're watching the other person present. So I think we're probably going to go over 3 hours today, guys. We want to keep it as close to 3 hours as possible, because that's usually the extent of your attention span. So, but we've got a lot of stuff to pack in here. We're very, very excited about this program today. This is going to make a lot of money for a lot of people for that first earnings season in January and February. Okay, that's all the housekeeping. I'm going to be taking the first part of finding these earnings moves, and what I'm going to be showing you is how to search for and how to choose the moves. I'm going to show you how to find the earnings that are coming up for a particular month. We've got some new features in Best Choice that really streamline that process, and I'll show you how to import all of the stocks that have earnings for a particular month into Best Choice so that you can start working with them immediately. I'm going to show you 2 or 3 different ways to look up the earnings date or the earnings release date for the stocks. I'm going to do a couple of wizard searches in narrowing down the high probability moves with the cycle wizard. Obviously, we don't take trades on everything that has earnings coming out. We want to find those that have the seasonal repeating pattern. They go up every year on the same earnings report. So we're going to run some wizard searches real quick. And then I'm going to show you a little bit about how to analyze the charts, both the seasonal and the 3-line chart, or the linear chart, to create your watch list. And typically what you want to do is, pick 5, 10, 15 really high probability, high consistent trades that seem to react to their particular earnings reports. Now, I'm only going to do part of that because Gary is going to talk about trading, actually making the trades, how to get in, out, and different ways or different types of moves that these earnings trades take. Okay, let's start with the best choice here. Now, up until just about a year ago, we had to just go through the seasonal charts. We could run a search wizard and we could find moves, for instance, in January, but we had to go through the charts individually to see which ones had earnings in January, or did they have earnings coming out in February. It was kind of a laborious process. But with the addition of our import-export feature, which we've shown you before, we have the import button here, the export button here. This finding these earnings plays has become a lot easier, because all we have to do is find a source that will give us a particular list of stocks that have earnings coming out that month. Now, the source that I use myself is FinViz. This is what it looks like when you come into it. Yeah, sorry for the slow computer here. Let's refresh that. There we go. And right here they have a free stock screener that you can use. And again, I'm not going to go into detail on this because we've taught this in previous training sessions. But I use this during earnings season because I can pull up stocks that have earnings coming out today, tomorrow, yesterday, next week, or for this month. I don't know why my screen is flashing, guys. And I've got some searches saved here. And earnings this month right here. So here are 43 stocks that had earnings that came out in December. Now what I want to do is I want to import this list into Best Choice and run it through the Cycle Wizard. But I don't want to import all of this data here. I don't know why my screen is flashing, guys. I apologize. So I have built a custom list that only has the symbols. And so I've shown you this before. There's an export button at the bottom down here. Now, I think I'm having, there we go. Right there is an export button. It asks you to name the file and it will export it. I usually put it on my desktop. And then all we have to do is go back into Best Choice, create a user list. Let's see if I deleted. I'm going to do a quick example here. I'm going to delete this list. And I actually saved my October file that I exported from FinViz. I kept that so I could use it as an example. So this would have been my October earnings. I create a new user list. Now that list is empty right now. I'm going to import. I'm going to go find the CSV file, October earnings right there. $472 companies had earnings come out in October. So when I was looking ahead to October to trade, to find these earnings moves, I have every company on this list that is going to release earnings in October. Now, some of these are going to be early October, mid-October, late October. I don't know that yet. I'm going to show you how to find the actual dates in a minute. But what I want to do with that list next is run it through the Cycle Wizard. Right there, there's my 472. Now, in the interest of saving time today, I already ran the Cycle Wizard because I want to run this twice. Now, this is just a personal preference, but it's something that I think can help you find the best of the best a little quicker. And what I did, the first time I ran the list, I just ran it with my default settings, 14 to 45 days, and it created a cycle trades list. Then I came back in and ran this a second time on the same 472, but I ran it for a shorter period of time. I ran it for 7 to 21 days. So now I have two cycle trade lists, one with the standard 14 to 45 days, another with a shorter 7 to 21 days. The thinking behind this is if the stock moves both in a short period and continues in a longer period, that gives it, in my estimation, a little more probability than if it's just on one list. So as I said, I already ran this. My next step is to find those stocks that are on both lists. So I'm going to use our intersect button. Now I can intersect as many of these lists as I want, but I just want to intersect the two lists that I created. And what did I do with them? Oh no, I'm sorry. I skipped a step. Excuse me. I have to go create a user list. Here we go. Here are my two cycles. There's my 7 days, there's my 14 days. So my next step is to pick each one, go to October, and here I need to create the user list. So this is my October 14-day earnings. Now I want to do the same thing with the 7-day. Excuse me if my voice is giving out. I'm at the tail end of a cold this week. Okay, here's my 7-day list. Okay, now I have my two lists that I can intersect. Right here. Highlight both lists. Now what this intersect is going to do, it's going to create a new list. And just call it Combo October. Name it anything you want. It's going to create a new list with only the stocks that appear on both of these lists. If there are any stocks that are only on one list, it's not going to include it in my Combo October. So let's go ahead and click OK. Right there. And you can see it came up with 56 stocks that appeared on both the 7-day list and the 14-day list. So typically what I do is I start with these stocks first. Now, I still want to go back and look at some of the ones that maybe appeared only on one list. It doesn't mean that if they didn't intersect that there aren't some good trades in there. But these are the ones I want to start with. These are the ones that are I consider the best of the best, but there may be some good trades left on those other two lists. And so the next step is to go through and start analyzing these. Now I'm not going to spend the time to look at a bunch of different ones. I've picked out some and put them in a user list that have the features or the characteristics that I want to point out today. But typically you're going to go through that list of 56 and you're going to be looking for these type of characteristics. So let's start with Onyx Pharmaceutical. Now the first thing I want to do is I want to go find that exact trade that I got from the Cycle Wizard. To do that, we go to tab 3. And guys, again, we're going to whiz through this stuff. If you don't understand what I'm doing here, get with your coach. I'm not going to stop and explain every little step because we've done all this teaching before. And I'm looking for my October. End of October. Okay, apparently it's duplicated. If it duplicates a trade date, it doesn't necessarily replace the name of the list. So it's either that one or, no, there it is. Okay, the first thing I want to look at, I see that this seems to be a reaction after the earnings report comes out. In fact, this tends to go down before the earnings report comes out. But I want to pay attention to the individual years here. This is my composite of all 10 years or 11 years, but I want to look at these individual years. Now what I see over here, and we've taught you how to look for consistency, I see that the past 4 years, with the exception of 2009, were all double-digit moves in a very short 14 days. So I like that. That's something that I want to see. I want to see not only is it probable, 10 out of 11, but that it's consistent year to year in the size of the move. Now, one thing I do when I see one of these recent years that is smaller than the other ones, I always highlight that particular year, because this 6% move is assuming that you got in exactly on the 30th and you held on exactly till the 13th. And as we've taught you, these start and end dates are a window of time. I call them a floating window. They could start a little early, they could start a little late, they could end early or end late. So if this smaller year concerns me, but I like the consistency of the other 3 years, I highlight 2009 and I see it still made the move. But if I had gotten in here, I would have missed part of the move. If this was on my watch list, I'm typically going to start watching this a week or 10 days ahead. And when I see this price flatten and start to turn around, my entry point is going to be down here. So if I want to see what I actually could have made, if I had timed it just right, got in here, and I'm not just going to get out on the 13th if this thing is still going up, I can go over here and click exact select coordinates, and let's say I got in perfectly at the bottom and stayed right to the top, and now we see that 2009 would have been an 11% move. Again, I'm not just going to get in on the exact date and get out on the exact date. Conversely, if I'm in a position and let's say that the stock gaps and moves up for 2 days and then starts to turn around, I'm not going to sit there and watch my profit go away just because it says it should last to the 19th. If I'm live in that trade, I'm going to take my profit. So anytime you're analyzing these earnings moves, pay attention to the individual year. And if you see one that just, sometimes it did only move 6% that year. But more often than not, when I select that year, we can look at 06, see it made a very quick short move. But if I had gotten in here and stayed till here, I would have just broke even. But I would have ridden this out. So just picture yourself in the trade for that particular year. If this stock's going down just because it says to get in on this date, I'm going to get in when I see that report and when I see that pop. Now, the other thing I like to do besides the seasonal, for this one, okay, end of October into mid-November. I like to go back and see the actual price movement each of those years. So if we find at the end of October for 09, right in here, look at that move. For 08, there's the end of October 29th. There's even a gap there. And if you want, you can just highlight that section and get a close-up look. Right here was probably the earnings. Now, I can go look up the date for that year if I want to, but typically you're going to see that gap right around that earnings time. And that's what I want to see. I want to go back for 5 years. Let's do this with Netflix. When does Netflix move? About the same time period. These are all October trades. 9 out of 9. Now, I would have been concerned about 2008. It did tank, but what happened in 08? September, October, the whole market tanked, right? So we know fundamentally that there was a reason for that to happen, not necessarily just the earnings report. The whole market was doing this in 08. So I would take that year with a grain of salt. But the other, look, 5 years of double digits with the exception of the whole market going down in 2008. So this one has a very, very good consistency. I like this kind of consistency. So let's go back and look at that time period. Again, it's going to be somewhere in October, right here. That was probably the earnings release right there. Here's what it did the next day. '08, we know what happened to everything. Pull up right, probably right here. I don't know where my months went. So I not only like to look at the average size of the move during that time period, but I like to also just confirm it by going back, pulling up usually a 5-year chart, and just sort of highlighting that particular time of each year. And that also will tell me, does it tend to gap up after the earnings? I know it goes up every year on that earnings report, but does it just move up the next day, or does it gap up? And that's going to help with my expectation of how am I going to get in this trade, how am I going to get out of the trade. Gary's going to talk about charts that tend to run up before the earnings report, charts that tend to gap after the earnings report. And what I want to do, what you want to do is plan your trading ahead. Some of these stocks you may want to get in a week or even 10 days before that report comes out. Some of them, if they tend to go down before the earnings, you may be able to wait till a day or two before the report because you know it tends to gap. And if it gaps and flattens out every year, then you know you're not going to hang around and wait for it to keep moving after the gap. So Gary's going to go into the details of determining how am I going to get into this trade. Am I going to get in early? Am I going to get in at the last minute? And am I going to stay in after the report, or should I just take my profit the first day after the report? Gary's going to go through all those details. Now, the one thing I want to do as I go through and analyze, I'm picking my trades. I'm picking the ones that I think have the best consistency, the highest probability. These are just a few that were on my October list. that have the type of charts that I want to look at. Here's a good example. 09, it still made the move. But if I got in right back here and I watch my profits go up, 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 and it starts to turn around on me, am I going to stay in all the way to here just because it says the 28th? If I'm actually in this trade, I'm taking my profit when I see this start to turn around. And so even though this is showing that it was a flat move, it's assuming that you stayed in for these exact dates. If you'd actually been in that trade, you would have still made a good profit that year, probably a double digit. So as you go through and find these, you're analyzing these, you're finding the ones that have good consistency. What I recommend is when you find a good trade like this, there's a little save button right up here. I've shown this in training before. And I recommend just starting a list of the actual trades that you're going to be watching for earnings. And we'll call this October earning trades. Now, this is not a user list. These are going to be the actual trades that I'm picking out to put on my watch list. So we could go put, let's put the Netflix on there. I've already created it, so I need to go find that one. October earning trades. I want to add Netflix to that list. Let's do Onyx. And of course, big one, FFIV. That was about 1,000% profit for most people that were in it this year. So after I'm done analyzing my 56, I'm going to go back to the 14-day list and look at the ones that maybe didn't make it on the intersected list. I'm going to do the same with the 7-day. And as I've gone through and picked out all of the trades that I like, all I have to do is go to my results up here, go down to my October earning trades, go to October, and boom, there's my watch list. These are the actual trades that I picked out. Now, with the, I've got the trades in the start and end date, but I need to know the exact day that these earnings reports are coming out. The quickest way to do that is go up here to Internet Links, come down to Current Stock, and right here, this will take you to briefing.com for the very stock that you're looking at. We were on FFIV, so there's FFIV. The next earning is going to be January the 19th. And that is the quickest way to find the date while you're in Best Choice. There are several good websites that will bring up the earnings date. Another place that I like to look for dates is in my Thinkorswim. And I don't know if other brokerages do this, but if you look on my watch list over here, Thinkorswim has put in, this came in about, I think, 6 months ago. They have these little books here. If you click on this book, it tells you the next earnings release for that particular stock. Now, remember the file that I exported out of FinViz. Remember when I exported this file and I had my October earnings? Well, watch what you can do here. If you click, it's kind of hard to see, but if you right-click on this little gray dot next to symbol, I can create a new watch list right here. I'm going to call it my October earnings. You save it. I don't have any stocks in there. Now here's my October earnings. It's empty. I'm going to right-click this dot again, and I'm going to go down here to import. This will import that exact same file that Best Choice imported. Not responding, of course. There we go. Sorry for the slow computer today, guys. Looking for my October earnings. Let's do this. No, all files. Oh, I'm in the wrong place. Right there, October earnings. This is the file that I downloaded or exported out of FinViz. Watch this. Boom. There's all the stocks that had earnings coming out in October. I can keep those. Okay, not that symbol. I can keep those all on one list. And all I have to do is scroll down and click on the date. If I happen to be on Thinkorswim and not in Best Choice at the time, I can just get my earnings dates right here. Now, I don't like to have this big of a list, and so what I'd like to do during earnings season is go back to FinViz, and I pick out earnings next week. And I do this on a weekly basis. And I can export this list into Best Choice if I still want to look for some other moves that I didn't pick at the first of the month. But I can also import this list, it's a shorter list, into Thinkorswim and have my watch list week by week. One other thing you can do here on FinViz in terms of finding the dates, if you go back to Custom, open up settings here, and I can have my symbols and right here earnings date, and I can just print out this list, and then I've got it on a sheet of paper. If you're more of a paper guy than a computer guy, you can just print out your list and you know, and it will tell you before market or after market here also. So just a quick review, guys. We're looking for these good earnings moves. And to shorten the time process, we want to import the list of stocks during the month that the earnings are coming out. So you're going to have 2 months coming up after the first of the year. There'll be earnings starting in January, and there'll also be earnings in February. We want to import that into Best Choice. We want to run it through a couple of cycle wizards. Again, we're looking for quick moves, so we don't need to put in 120 days. We're looking for those very quick earnings gaps and so forth. And then we're going to analyze and pick out the best of the best. I typically like to be in anywhere from 4 to 8, maybe 10 trades at once. And so I like to have 2 or 3 of these a week if I can, picked out for the earnings moves. And then we save those to a watch list. As we find the good trades, we save those to a watch list, and then we've got our entire watch list for the month right here, the exact trades that we want to watch and be a part of. All right, let me open this up. And Gary, Scott, anything else you want to add to this part? I'm going to try to go ahead and shorten it up here because I know you guys have a lot of material.
Yeah,
Not me, Scott's fine.
Quick mention that you had made a point about start date and end date, and I think everybody on the line understands that what Best Choice software does in its seasonality on the start date and end date. It's looking at the underlying security. You know, we like to trade the options, the derivative on the security. So it's really buying that stock at the end of the closing price of the start date, and selling it at the closing price of the end date. It's important, and I want to kind of drill this home because Stan mentioned it once, and I think most of us know this. It's a high probability window of opportunity. You know, on these earnings trades, I think Stan did a great job of showing on individual years. If you don't see a double digit, or it looks like, it's not that good, it's not necessarily indicative of what that earnings trade is going to do. So I just wanted to make that point that you guys understand on these earnings-related trades, you see these high probability moves, that start date and end date is only on the underlying security.
Yeah, and you're going to go into more detail, Gary, on actual entry and exit, and coming up with a strategy based on how it tends to move around that earnings time. I just was going through, for everyone's information, I just wanted to go through and show you real quickly how to go in and pick out these best of the best trades, because you don't just trade them all the same. You know, some of them you can get in the day the earnings report's coming out. 2 years ago, I got into Priceline 3:30 in the afternoon, and the earnings report came out after market that night, and I sold it the next morning. Other ones of these may run up like this right here before the earnings report comes out and then gap up. And so Gary's going to show you how to search and how to determine, should I get in a week ahead or the day before, how long should I stay in afterwards, and so forth.
Yeah, do you remember what happened on that trade with the other guy who decided to get cheap on that? He wanted a nickel and dime, and he asked for the bid price, and you came in, I think, and just took market.
I did a market.
It was like 5 before, right before the earnings on that, and he never got filled because he was trying to be cheap for 5 cents. You know, I would rather just get filled, especially if it's an explosive company like Priceline. And he missed the boat, remember?
Yeah, I think the bid and the ask was like 25 cents, and the bid was 23 cents. So he wanted to split it, and he put in a limit order for 24 cents at 3:30 in the afternoon. He never got filled. I filled the ask, obviously, because I put in a market order. So I filled at 25 cents. I sold it the next morning at I think about 11 o'clock for over $1.50.
You remember that, Scott, don't you?
Absolutely. That's a classic mistake. That's in my book of rules. I think it's rule number 4. Many a profit was lost for want of an eighth of a point.
Yeah, exactly. He was splitting those pennies and missed out on the whole move.
So don't get cheap, guys, on these things, on these earnings reports.
Gary, was there anything else that we talked about yesterday that it seems like there was something else I was going to show with the import, or...
I was going to say, did you show everybody what you had showed me yesterday, which is really great? A lot of times, guys, and I've taught a lot of people how to import from or export from FinViz, but you know, when you do that and suddenly you add the symbols, it's like you get a heck of a lot more than what you started with. And I was always wondering why that was. Maybe you want to go over, Stan, on FinViz how you can use the custom button to eliminate the other columns so you only have the ticker symbols.
Okay, yeah, I've done. We did that in a previous, I think, in our very first advanced training, but I'll quickly go through it here. Okay, let me start back at the. Wow, what is going on with my computer? This website is not acting right.
Hit refresh.
Well, here, basically, this is where it is. Okay, there's a settings area right up here. When you go to the custom, this basically is you customize your column headers. What columns do I want to see? And before you export, it's a good idea, because this kind of information will not import into Best Choice. It will just leave it out, and it'll tell you, you know, 500 symbols not imported. Well, this is what it's talking about. It won't import this other data. So basically what you do is come to the custom tab, and uncheck everything except the ticker symbol, and then go down and export that to your desktop. That's what Gary's talking about. And I'm going to shrink this because it's really freaking me out here. Okay, guys, let's see. Well, I know it's a little quick for the first break. Gary, do you want to get started and take a break in the middle of yours, or do you want to take a quick break now and maybe start at 5 minutes till the hour?
I'm sure everybody probably wants to take a quick bathroom break. That's fine, and I think anybody who knows me online right now knows that I tend to talk a little bit, so I'll probably end up running on. So why don't we take a break right now?
Okay, guys, we'll take a 5-minute break. When it gets close to the 5 minutes being over, you'll see a take your seat sign down here at the bottom of this screen, and then we'll segue right into Gary's next part. So everyone, be back in 5 minutes. Okay, I'm going to give everyone just about another minute here to get back to your seat. We're going to move on to Gary's section of the program and keep this rolling. Okay, Gary, are you back? Hello, Gary.
I'm back. I'm back.
Okay, you ready to take the baton? I'll do the little introduction here while you get your screen set up where you're going to start, and then I'll pass it off to you. Okay, Gary is going to continue with what I started. Once you've found your trades that you are looking forward to and you've got your watch list put together, Gary's going to teach you actually 2 or 3 types of different types of earnings moves because some of these stocks tend to react before the earnings, some tend to react because of the earnings, some tend to continue reacting, and he's going to go through how to determine which way you're going to plan on trading each one of the moves on your watch list. He's going to talk about entry strategies, expiration strategies. Which month do I trade? Do I take the current month? Is it too close to expiration? Do I take the next month out? Sometimes you may want to take options in both months, and he's going to go over all of that. And finally, he's going to talk a little bit about some of the other moves that tend to happen right around the first of the year that aren't necessarily tied to earnings. So Gary, I'm going to pass this off to you. And you can take it away.
All righty. First, guys, I'd like to say thank you for joining us today for our year-end training that I think is going to be really dynamite. You guys are going to walk away with a lot of good stuff, and I think Stan did a great job to show everybody how to find the earnings and how to import them and how to organize it and create your watch list, in other words. I also want to wish everybody a very happy holiday season. This is the Christmas season, so part of it is also to give, and I think anybody who knows me knows that I like to give a lot. I'd also like to mention that this last year, probably specifically this last earnings quarter, was the absolute best year for a lot of people, and it created a lot of life-changing events, and I mean truly, truly life-changing. And one of the ways, of course, that we profit from our software is from earnings trade. It's like Pete taught me, stocks, like commodities, move because of an event. There's really only 2 events that can happen in the future, a known event or an unknown event. Holidays are an event. Earnings are an event. That's what a company tells us how they're performing in the marketplace, and the market reacts either positively or negatively. And the advantage that we have as best choice software owners is these seasonal charts that, will tell us in advance what we can expect that underlying security to do. The earnings is where a lot of our users and end users make a lot of money, besides some seasonal typical repeating events like retail or energy or those kind of things. Okay. There's really only 2 ways to trade earnings, but there's a spin-off of the first. There's what I call a RIE and an RAE, or a RE and a RA, if you will. One is a run into earnings, and the other is a run after earnings. We expect the stock to take a big pop, Generally, most of us are very bullish traders. I know I'll always be an eternal bull. But some of them will have the ability to run up into earnings, bust through, and then still run after earnings. And there's techniques that you can use that I'll show you today of how to be able to identify that. I'd like to start with the run-up to earnings. And this is a classic example, FFIV. What a great company, F5 Networks. In October, this was a huge home run for anybody who made this trade. And I've already pre-done all of these so you guys can see this. I used a 21-day time frame to be able to visually show people how that composite yellow line, you can see it gets green before the dots, which are the earnings releases, goes through them and busts on up. And this is a classic example of a run up to, bust through, and a run after earnings. But keep in mind, when an impending event happens, implied volatility, what the seller and the bidder expect to happen, will increase as that impending event gets closer. Now, I'm sure some of us have made trades where we say, gosh, the stock moved in our favor. You know, it ran up and I lost money. Well, why is that? Well, that's directly related to implied volatility. It's called volatility crush. I'm sure a lot of us experienced that. So one of the ways to trade these things is when you're looking at the particular underlying security, knowing when the event's going to happen, start looking at things a week or so early, and you can see the implied volatility, what it is, and it's important to look at the spot month, the front month of what you're looking to trade, as well as the next month out. One of the classic examples I like to show people is the classic Google trade that ran up 77 points this year. The stock had closed the day of earnings release, that is, it was being released after market, $540.93. You know, and based on what we expected historically the stock to do, applying it towards the closing price, actually I'll walk you through that particular trade. Well, if I can type right. You guys know how to remove a year. I think everybody knows how to do that. I won't go into those that detail of it, but this move that we had expected, I had looked at the particular security and where was it at in its linear regression of price movement on that particular day. Now, one of the things that you'll see are these kind of charts, and you're going to say, geez, oh, Pete, this is overbought. You know, how do I pick out a strike price on this thing? Because everybody looks at 6 months or 3 months usually in determining where to position themselves in a strike level. Well, one of the things that was an anomaly this year in September was the QE2 and the Fed's printing money just kept the market moving. So typical high ATR average true range stocks like Apple and Google and all these stocks that we expected to retrace the last couple of weeks of September didn't do it. It just kept running. So it kind of skewed what we were looking at. We were hoping, you know, this stock would have come back down and was around this lower level. So with that knowledge, you would have had to go to a longer term chart to be able to see where you could expect that security to run to. If you went to a 2-year chart, and I'll move it back to that same day of of October the 14th, you see a totally different picture. There's October the 14th, and the security is sitting at the 23% extreme of its price movement. What's interesting is that if you applied the historical average percent move you expected the stock to move, and again, it could be more, it could be less, and you're looking at this chart, it fell right above that mid, meaning retracing back to about the mid of its 2-year linear regression. Actually, that strike price I chose was the 600. So that's the technique, guys, I want you to kind of get used to doing, to be able to, if you can't see where to pick your strike price on a shorter-term chart, go to a longer time frame. Like, you know, here was Google on that day, and my gosh, it looks like it's way overbought. Where am I going to pick a strike price? It looks like it's in gray nebulous land.
Hey, Gary, can I interject one thing?
Sure.
You're doing this because we're specifically looking at earnings plays, right? We know that the earnings move happens. Typically, if we're trading a stock in a month that doesn't have earnings coming out, you're not wanting to take those that are already at the upper band. But we're wanting to make this trade happen because of the earnings report, right?
That's a great point, Stan. Thank you. Yeah, guys, this is specific for earnings-related trades. If you can't see a strike price based on a 6-month to 3-month chart, go to a longer-term chart, especially if you know that the market has been pulled up really hard, like what happened in September and October. You had to go to a longer time frame. Another example of that same situation would be a trade that that I made and a bunch of other users did, which was well, I'll start with this one first. This is a great example. It's one of the first stocks that Pete ever showed me. It's a great company. Coach. It's a classic retail earnings-related trade. The stock just explodes up after earnings. However, and you can see this here, I think I still have this set at 35 days. Now here's the trade. This also is an example, everybody, of a run-up to and a bust through earnings. And you can identify that by looking back into history, and Stan's already showed you that technique, where you go to a longer time frame to see what did it do last year at that time. In other words, what did it do when it exploded? Did it keep running? You know, you're going to get a natural retracement after an earnings trade where people are going to be taking profit off the table. But a lot of stocks, Google, Priceline, Baidu, CME, Netflix, these stocks will typically tend to run a day or two afterwards. And so, you know, depending on how many contracts you're playing, you can take a certain position off the table, you know, take half your positions off the table, principal plus profit, or 80%, leave a couple of stingers on the table, and let those stingers run afterwards. And those, since you purchased them so cheap, if they continue to run, can almost equal what you've taken off the table. So going to these longer-term charts, you'll be able to see what did it do the year before. What did it do the year before? Does it have that capability of retracing and then busting up further? So this is a good example, in other words, of a company that does that. However, if you're looking at the 6-month chart, which is where most people have the default setting, earnings were coming out October 25th. I'll take the chart back to that day. And to see something very similar to what Google was. It's showing that it's overbought. Well, how the heck do you pick out a strike price on this? It's difficult. Unless you go to a longer time frame chart. Now, if you use the default settings of 14, you snap that area, It's a nice, strong, high probability win, a strong rating, a good average move. This year, of course, it did 20%. It did better than it ever did. All of retail did well this year. That's the other thing, folks. Be aware of what's going on in the market around you. You know, when Coach exploded, and I'm guilty of this as well, I should have focused my energy and attention on the retail sector. The retail report came out from the government saying that this year is going to be better than last year. I was listening to my local radio station, and they were interviewing one of the heads of the Chamber of Commerce, saying that they're going to be hiring a lot of temporary help people. It's going to help the economy. A lot of people are going to get some jobs to, you know, help some of the people that aren't employed. Well, those should be, you know, big green flags for you, saying, hey, wow, you know, I should maybe focus my energy or a little bit on those earnings on the retail sector. Now, I'm going to bounce you a little, guys. Follow with me. If that's the case, and you would have known to focus your energy on the retail sector, Stan showed you how to find all the universe of stocks that are coming out in the next month and then create another list for this week. I don't know, Stan, did you show that also? Did you create two lists, one for the month and one for the week that's upcoming?
Yeah, I typically, you know, at the beginning of the month will run a list for the entire month. So, you know, January 2nd or maybe the 3rd, depending on how much fun I have on the 1st. On January 3rd, I will run a list for the entire month of January, and I'll start going through and putting together a watch list. But I don't like to keep track of that entire monthly list each week. And so usually on a Monday, I'll go back into FinViz, and I'll run a list for the earnings coming out the following week, next week. Because some of these, as you're pointing out, you want to get in maybe a week ahead of the earnings report to take advantage of that run-up to the report. And so I'll typically run a weekly list at the beginning of the week just to refocus my attention on what I may want to be getting in the next few days without having to look at that huge monthly list all the time. So, yeah, I did go through that.
Thanks for that short answer. All right, guys, back to this. Thank you, Stan. So, in other words, just keep yourself aware of what's going on around you. And when Coach came out with earnings the next day and exploded, we all should have focused our energy on that. And who knows what's going to be coming up in the first or this last fourth quarter, the first part of the earnings season coming up. So just be aware of fundamental events around you that can focus and hone your attention onto a particular sector. You can go to FinViz, and if you were aware and you were paying attention to the fact that retail was going to be exploding, or you maybe focus some of your energy on that, when you go to Screener, you can sort by sector. So I would have sorted by consumer goods, which is the retail sector. And, you know, do all of your other settings of earnings dates, volume, price, optionable, U.S. So you could have created that and focused in on that and created a separate watch list just for that, focusing in on the retail. So I wanted to kind of segue into that so you guys will be aware that you can create a separate watch list based on a sector. Stan pointed out a good point yesterday. If you don't know a particular company, which sector it falls into, you know, you could simply type in the symbol right here. And, well, if I would have typed in the right symbol.
Gary, you still have consumer goods selected.
Oh, that's right. That's why. There you go. Thank you. So you know, in other words, that this is the technology sector. If you don't know which particular company, so you would go to technology. Okay. So back to this here. If you were aware and you missed that, and you knew that retail was coming up hard, now, again, where would you have picked out a strike price if you went to a longer-term chart? Again, because this was the pull-up of the entire sector. Everything was moving up. And you went to that longer time frame. Whole different picture, folks. Sitting at the 23% extreme. Stock closed at $44. Typically, it'll retrace to around the mid or a little bit higher. Again, you're going to want to take what the average expected move you expect based on history, using seasonality, which is extremely powerful. That gives you your target. You need to set your targets of T1, T2, my first target, and then where's my next target. And determining that target is going to be where is that last high in the last 3 to 6 months. That's where the stock will typically retrace to, which you can see in this area here was right up in this area, which really is where the stock was at right now, so you couldn't have used that. And this was a classic double top where it crashed down. So for this particular one, you couldn't see in the past 3 to 6 months where your potential T2 would be your second target. So you would have had to rely strictly on the seasonal of what you expected historically on average that particular security to move. That's where your T1 would be. And you have to set those targets, guys and gals, it should be politically correct, because that's part of managing your trade when that stock moves. If it hits that, when do you take your money off the table? So, again, I wanted to show you some techniques that I've used that help me determine a strike level, you know. And, of course, this is an example of a run-up to earnings, an explosion through earnings, and then it meandered sideways, but it kept running. Another example of that same concept is Deere. Understand the industry that they're in. Caterpillar came out with great earnings. Deere's a great, great company. I remember used to work in the farm country selling health insurance, and all the farmers had Deere. And it's just a very, very strong, well-run company. Just from a visual perspective, you can see that composite run up, earnings, the composite continues to go, and you can click on any particular year to see what it did on that individual year. I believe I have this already saved, which shows an interesting thing. Now, guys, remember, the rating, you know, a lot of people are fixated on that, but it's a mathematical formula. It's very powerful. It does a lot of heavy lifting that Pete developed. It's that win percentage multiplied by the average profit divided by the average number of days. So you have two numerators and one denominator. Doesn't mean it's not necessarily a good trade, though, folks. Look at that. That's a 100% winner. That's strong as onions. So that's a huge move. And if you look at the consistency of double digits, that should be a real heads up for you to say, wow, maybe I should start looking at this in the end of October, beginning of November. You can determine when earnings are coming out, and you can play that run-up in volatility. Volatility is going to be relatively low here. As the impending event comes closer, volatility will increase. Well, guess what's going to happen to your option? It's also going to increase. The event happens, and then the trade then, you know, this is an example of it continuing to run after earnings. So one of the things I love to do, or one of the techniques that I use, I should say, in managing my trade, and when do you get out, when do you pull your money out? Now, this is also an example of where if you did start watching this security early and you were able to buy a cheap premium at the end of October, let's say, if it was oversold, you could buy November's expiration as long as earnings were before that. And understand that you're going to play the run-up in volatility and you're going to take your money off the table before earnings, before that impending event. But at the same time, you could purchase a December expiration. You're going to pay a little bit more because you're buying more time. However, you will not get volatility crush, and those Decembers will continue to run. Now, this year happened to be pretty interesting. I'll shorten this time frame so you can see this particular year. You know, earnings happened, the move went up. And if you had Novembers, you could have played that nice run-up, this area here, taken your money off the table. But this was earnings right here. It ran up, and then it started to reverse. Very important to set a set of rules for yourself of if you're buying December's expiration, if that trade starts to go against you, meaning you have to do risk control and money management. I pretty much have a hard and fast rule that I stay by at 50% of the premium that I pay for the option if it goes against me. I take my money off the table, period, and I don't look back. However, I want to show you how you could have managed this trade if you didn't have 50% loss of your premium, and when would you have taken your money off the table? As you guys know, I like Thinkorswim. It's got phenomenal charting. This is what I like to use to monitor a trade after earnings. When do I take my money off the table? I have the linear regression lines on here. They are very close to best choice. Best choice is, of course, proprietary. None of us know the standard deviation that was used, and they're extremely accurate. I like to use Heiken Ashi candles that are either green or red. I like to have volume on my main chart. I like to use a classic 10-period exponential, 20-period simple. And this is not hard, guys. I like to use a MACD set at 817.9 and a detrending price oscillator, a DPO, set at 1010. If you guys don't get all these settings now, you'll get it on the DVD. But as long as price stays above, and the red line, which is my 10, never crosses my blue line, which is my 20, it keeps me in the trade. Now I see a doji here that's a bullish, then I see a doji here which is a bearish, and now I have price significantly busting through. Now guys, if I put my cross here right there, right after it peaked on the high, by the way, my time frame that I'm using, you can use a daily or a one-day 10-minute. I like to use a one-day 10-minute and 5-minute, but I also will flip to a longer term of a 10-day hourly, just to see the macro picture, because that's slower to react. But this is my primary method of keeping me in the trade if I've got a lot of profit and I'm just trying to tweak it to know when is the security going to start turning against me, when is everybody else going to start taking profit, you can see here that I have negative volume building, I have a MACD crossover, and my DPO fell below 0. That's a trigger for me to get out. My final is my 10 EMA crossed my 20. So this is a technique, guys, you can use after earnings trades to keep you in a trade longer and be able to squeeze out more profit. I know I'm bouncing here a little bit, but hopefully you guys will be picking up on this. So back to DE and the original I have 2 of them here. So you could play the run-up to earnings, which is really starting here, and it's a run-up to, yeah, it retraced, but then it kept going. Forgot what day earnings came out on this thing. I think it was the 9th. So that's one example. Let me go to another. Kind of bouncing in this order here, so anybody who knows me knows I do this, so just follow with me here. I'm going to give several examples of what I'm talking about. ICE, which is a great company. This is an example of a run-up to and after earnings. You can see it here. Great consistency. And you can, because there's not a lot of years of history on this particular company, you can almost visually see the blue lines in the background. But you can really see this becomes blatantly evident when I go to a longer-term chart. And where is this earnings here? I think it was from here to here. You can see that the run-up in April, if you were looking at things early, you could play that volatility run-up. There's earnings. And it kept going for a couple of days. And how do you know if it's going to keep going? That's how you use these charts to keep you in the trade. And of course, you could switch to the 10-day hourly, which also gives you the more macro picture of what to expect. And there you can see it right there.
Gary,
evident again. This is on an hourly, so it's going to react quicker. I would have wanted my money off the table right here because it really started to retrace here.
And Gary, this is Scott.
Yes, Scott.
Can I say something at this point?
Yeah, please interject.
On your charts for staying in a trade like that, there's a classic sign of technical trading, which is happening again right here in your charts. Any good stock, when they're on a roll, on a ride up, this Deere, for instance, it stays above its 10.
Yeah.
It rides the 10 all the way up. The 10-day.
Good point, Scott. Thank you. Thank you.
Right.
Yeah, it's a very powerful moving average to be able to just track and monitor your trade. That price will continue to stay up above that 10 EMA. And of course, you're going to get a heads up here on the MAC when it crosses, when the DPO crosses here. This is an hourly. Again, you flip from an hourly, 10-day hourly, to a one-day 10-minute, one-day 5 minutes. The price will stay above that 10 EMA. And this is a classic example of the ICE that I was talking about. It does the same thing, and I could go and show you that chart. I just don't have time to do that. Let's go to another one. Great company, retail. Again, if everybody was paying attention, the retail reports came out. You could have had this in a watch list using consumer goods, FinViz, import it, and you'd have all of these great trades to be looking at because the whole sector was doing well. And here's a classic example of a bust up after earnings. Let's take this back 6 months. This was the earnings right here, guys. But here's a beautiful classic run-up. And then it hit earnings. I don't know if everybody can see this. Let me maybe do that. If you were watching early, knowing that earnings were coming out in September, start always looking at security early. It's an event, an impending event. You could have played that volatility run-up when you saw that it was oversold. That date happens to be after, of course, expiration Friday in September, but you could have still bought in September and played the run-up of implied volatility. You could have also, obviously, as it became closer, not buying as much time, bought the Octobers. It exploded, ran up, retraced, came down. Now, this is natural sell-off right here. This is the natural sell-off. But what did the stock do? It kept going. And you can monitor it by that 10 EMA on a 10-day hourly. On a 10-day hourly chart. It's a real classic way of being able to monitor a trade and squeezing out some more profit. But also remember, guys, profit is a personal decision. You should have your targets. Scott and I and Stan are a believer that, don't get greedy. Have your targets. If the stock hits that target, take your principal off the table. You can leave some on the table and let those run, but don't get greedy. Look at another example. I love this company. They're strong as onions. Or garlic. Here's a classic example of a run-up to earnings. You see the impending event. So you could buy April's on this, looking at the security sometime in the end of March, so you've got enough time, and play that implied volatility upwards. Because if I went to a 7-day and said, what happens after earnings? I know there's a 75% probability that thing's going to tank. So I'm going to play the run-up to that and make money on it. Look at another company. Sign Up. It's a great company. Another example of a run-up to earnings. Fantastic consistency. So again, you'd want to look at something like this at the end of March, beginning of April. How would you know? You'd look at the linear regression lines. Where's it sitting? Well, it's sitting over here. You know it's oversold. You do the math based on what you expect that average run-up to be, which is right here on our seasonals. That average is very, I use it a lot. And I apply it to the end of the stock, the closing price to stock price, the day that I'm looking to make a trade. And that gives me my target of where I can expect on average that stock to go to. It could be a little bit more, it could be less. But I need to have a target. That's another classic example of a run-up to earnings. I think I showed you Coach. Oh, I never finished with Coach. which I explained to you guys, was how I went to determine to find. I went to a longer-term chart, applied what I expected on average that stock to move. That gave me my T1. This is an example of a stock that continues to run. Again, you can monitor that based on a 10 EMA, on a 10-day hourly chart. But one right after Coach was Ralph Lauren. Now remember, guys, take a look at this right here. And visually, well, let me redo this. I'm going to take it actually back to that day so you can see it, which is the 25th. Okay, there's the 25th. See this pattern? Now watch. Ralph Lauren, which was coming out a week later. Looks like you're looking at the identical same stock. Of course, they were coming out on November 9th. Looks like the identical same chart. So how would you pick your strike price? Again, you'd want to go to a longer-term chart if this is what you're going to be looking at and seeing coming up with a great earnings trade for the fourth quarter. You went to a 2-year chart, took it back to that day right of earnings. Once again, it's sitting a very low extreme. And I took what the average percent move was that I expected the stock to do. Now I've got a 7-day. I'm going to remove 2010, 1027 to 1110. That was the average percent move I expected the stock to do. It had good consistency, especially a point movement. Very, very consistent. I also knew Coach just exploded a week before. So if I went to, so remember, 8.5%. Add that data back in. Stock closed at $99 among chart. That's the 9th. $100.92. $100.92 plus 8.5% gives me my target, where I could expect, well, if I did the math right, 105. Stan, I hit equals, right?
Hit your percent first and then equal, yeah.
Okay. There's my target. 109 we could potentially run to. I actually positioned myself early on this 2-3 days, especially when I knew what Coach did. And it wasn't $100. The stock was not at $100.92. I believe that's the day that I positioned myself, the 3rd. That was a Wednesday. Because, yeah, it was a Wednesday because the next Tuesday was the impending event. And if I took that same math, guys, applying it to that stock price of, let's say, $96 times 8.5%. Sorry. Plus, trying to get used to this new method of doing it. There it is, 104. And that put me right at about the mid, the retracement to the mid. Actually, that probably wasn't the day that I came in, because I remember when I did this math, the actual mid was sitting at 105. And that's exactly the strike price I chose. The whole point behind this dissertation, guys, is that look to a longer-term time frame if you cannot find on a shorter time frame where it looks like it's overbought. It's sitting up like that, and it's a strong company with strong historical earnings. Go to a longer time frame to be able to see where it could retrace to on a mid.
Hey, Gary.
Yeah.
I just want to reemphasize that the reason we're going through all these machinations of percentage move and all of that is because we want to take this earnings trade and it's already at the top line. I don't want people to think, oh, I can do this on other times of the year when it's not related to earnings. This is how I can set a strike price when it's at the top of the line.
Correct.
It's only because these are earnings plays that we know are strong reaction to earnings and we want to make this move, and we don't have that three lines to help us like we normally do to set a strike price.
That's correct. That's correct. Another great company, Baidu. Classic example of a run-up to earnings. Super consistency. Another example. Great company, BBY. Another example of a run-up to earnings. Another example. PNC. Great company. Run after earnings. I call this a Scott so great in his wisdom of 162 years on this earth. Dipsy doodle. That's what I call it, dipsy doodle. You can play it down, you can play it up. This is an example of an explosion after earnings. So, great company. Again, how do you determine this? You'd want to start looking at things maybe at the end of September, early October on this particular trade, play it down. And it doesn't matter. I mean, all these earnings that are coming up in the fourth quarter could have these type of patterns. So just be looking for them. Here's an example of a run after earnings. Excellent, excellent company. There's a lot of people that made this trade. Now, I did a longer-term run on this to be able to show you blatantly and evidently when that earnings pops out, you could actually buy December or January's expiration. For those of you who can't sit and monitor a trade and just want to buy some more time, understand there'll be some whips on it, but because you have some time that you bought, you don't have to be worrying about theta or time decay that bad. Classic example of a run-up after earnings. Another classic example is a company called APH. I'm sorry, this is a run-up too. This is where you'd want to play that volatility up to earnings. So you could buy an April expiration as long as that impending event is before expiration Friday. This year it happened to pop up afterwards. You can see that here. So here's that example of the run-up to, right? play that implied volatility here, buying April's. You would take your money off the table of the April's before the impending event, because you could see the stock starting to come down, which is a classic example that happens right prior to an event. People are scared, they're selling off, they're listening to talking heads or Whisper Report or whatever else is out there. And I think it's important to know that, using the software, you develop confidence in your trading decision, and successful traders are independent thinkers. So these are the people that aren't independent thinkers. They're selling off because they're saying, oh my God, Amphenol is not going to beat earnings, blah, blah, blah. What happens? It explodes. But if you would have bought May's expiration as well, you could have taken advantage of that, and that's where it would have exploded. On the other hand, if you would have done that on Google, and you would have only played the spot month, the front month, on Friday, because Google is notorious for coming out with earnings the day before expiration Friday, and you did the math and you said, okay, the 600 strike is where I want to position it, 6 strikes out of the money. Boy, it's cheap. It's only 40 cents. Man, I'm going to make a killing. Well, yeah, it was cheap. Google was only 40 cents at the 600s. You would have positioned yourself towards the end of the day when earnings were being released after that. And you'd be looking at the 600s in November going, wow, that's expensive. But I want you guys to see something here. Look at implied volatility for the next day expiration versus the implied volatility for buying 1 month out. Let's say we bought that and we bought that. You paid 37, they give you the mark, 37.5 or $3.75. And let's walk it 1 day forward. Here's the profit or loss right here. Well, still made money. However, what's important to see is what happened here. Implied volatility got sucked out to almost nothing. And more than likely, you would have had volatility crush. But look at here, it only went from 30 to 25. So, point being is you could play that run up and then take your money off the table. And I just wanted to show you that example on Google. Here's an example of a run-up after earnings. Great company. If you guys aren't familiar, CMG, Chipotle, Mexican Grill. Anybody ever go to their restaurants? They're constantly packed. Great, great trading company. Explosion after earnings. So be careful of earnings coming out right before expiration Friday because of volatility crush, like I explained to you on Google. You'd probably want to always look at, like when you're doing your scans and you're putting together your list for the fourth quarter earnings, and there's some that are going to be coming out end of January, beginning of February. You know, if they're in that first week of February and you've only got about 3 weeks left to expiration Friday, folks, you know, I'd rather buy some time. Even though the software may tell you the end date is before that expiration Friday, I've just seen it happen more often than not. The stock may meander sideways. Maybe the move isn't going to happen right away this year. Granted, you're looking for that big pop. But I've seen it happen more that you get volatility crushed than you do actually getting that pop and making more money on the front month. So just be careful with that. And again, when you're looking at the next month out, look at what premium are you paying? Where's the volume? You know, volume is a very important thing to look at besides open interest. You also want to look at your delta. One of the rules, hard and fast, that I have, I will not make a trade if my delta is less than 20. Hard and fast rule. Okay. Buy front month and next month. Spot.
Hey, Gary?
Yeah.
Can we just go over the front month, next month, just a little bit more in detail, because I think it's important. You're showing the volatility and how you can make money as that volatility goes up right before the report. It's important to know that you need to be looking at that a week or 10 days or so before that report, not 3 days before the report, because your volatility is already going to be up at that point. And one way to know if volatility is starting to rise or not, if you'll show them comparing the front month and the next month out, if volatility is pretty close to each other for those 2 months, then you're probably getting in before that front month volatility raises. And if you compare the months and the front month's already increasing more than the second month out, you might have missed that volatility move. Does that make sense?
Absolutely. I want to see it too, Stan. This is a very, very important subject. And so, Gary, please.
Well, that's got to be off of, you can do it off of Best Choice too, folks.
Yeah, but you can do it. You got to.
Yeah. I'm just thinking of if there's an earnings trade coming up this month that we can actually give as a good live example to everybody.
Well, I'd just like to see the Google example of last October, that one you on Thinkorswim.
Yeah.
Yeah, you probably use that. Just go back to like October 1st.
Yeah, we did this, guys, just to show everybody what we're talking about here. Let's say that you were looking at this earlier. What date did we use, guys? Do you remember? Was it a week before?
I think it was all the way back to the 1st.
The 1st? Okay.
Yeah, if we were using Google, I don't remember.
Yeah.
Now explain to the people, please. This is on the ThinkBack section of Thinkorswim, under the Analyze tab.
This is under the Analyze tab, ThinkBack, and I simply moved my date back, and you can move it to whatever month you want or forward.
Yeah, for those that don't know, this is historical options pricing. It's one of the few places I know of you can go back in time and look at what options prices were last month or last week or whatever.
Correct. But keep in mind also it's end of day, and you know what happens during the day if there's a lot of volatility, it doesn't reflect that, but it's still a good tool to be able to see that. Look at implied volatility here, guys, 35%. Right? On the October expirations.
Which is not that much different than the November at that point.
Exactly. Look at the Novembers, which are 28. So you could have bought a pretty inexpensive option here, but this is the key. One of the keys to look at is when you're looking at a strike level to make an earnings trade, what is the implied volatility for that front month you're looking at versus the next month out? If I walk this forward, you guys can see here on the 600s how that'll change. You see how the spot month, October, continues to increase? now 55, now it's 60, and we're on the 12th. There's only 2 days to the impending event, the earnings release. But you see the 600s here have not changed that much. And that's how you can see, if you're seeing something like this, guys, it's a big heads up. This is where you get volatility crush.
Yeah, Gary, if they don't, if some of these, if they did not attend our second training, we went into an hour and a half of detail on how volatility affects your option price. So those that attended understand what you're doing, but those that didn't get that disc may be a little lost at this point. But
okay. Well, we wanted to go over this, and it was Scott wanted to see this.
Yeah.
Very, very important point, guys, to look at when you're looking at earnings trades. Where is that volatility at the front month versus the month out? Makes a big difference on how much money you're going to make on the table.
yeah, it also is your strategy. If you bought both months on the 1st, you would be selling your October before that report comes out and making your money just on the increasing volatility.
Yeah.
And then
Doesn't always work that way.
No, it doesn't. It doesn't. But sometimes it really works out that you can make money on both months. You know.
Yep. That is correct. Scott, is that what you wanted to see?
Yes, and I want to see one more day, and I want to bring the people's attention to October 6:10 calls on this day, the day before. We all know Google's going up. One would want to be tempted to buy a cheap option. Let me look at the Google October 6:10 calls on the day before and the day after. The day before, please, again.
Okay, day before, the
yeah,
30 were 30 cents.
And in one day, the next day, what happens? Oh, yeah, that's a killer right there.
Was 79.
That's
go,
a killer.
wow,
What happened?
geez.
What happened to your $30 the next day?
And then what happens to your option?
Bye-bye. Zero.
You got nothing. There's nobody that's even going to offer you a bid. Volatility crush, guys, right there.
That's a trap.
That's also due to that being Expiration Friday, too, guys.
Yeah. Yeah. Thank you.
Okay. Hopefully that gives you guys some good meat on how to trade these things and what to look for. You can play the implied volatility run-up, buying spot month. Take your money off the table before earnings. You can at the same time buy the next month out closer to earnings, so you're not buying so much time. Therefore, volatility crush and theta won't kill you. In picking strike prices, you want to take that average % profit per trade that you expect the stock to move based on history. You apply it to the closing price of the day that you're buying the option to give you your target, your T1, if you will, target 1. So on this particular day for Google, again, it was showing that it was way, way overbought. You'd have to go to a longer time frame. You take that closing price of what, or the average % move you expect the stock to do. That's when you've run your lists, right? And remember, an important point, I think, that Stan and I and Scott try to make, that this is an average. Whenever you snap on something, it's an average. However, when you're moving your mouse and snapping on this chart, there's only one thing the software is looking for, because defaultly tab 3 is set at best rating a whole zone for a minimum number of days of 14. It's looking for the best rating. That's all it's looking for. But when you run those lists from FinViz you import for the fourth quarter earnings, and you run it through the Cycle Wizard, there are 5 very specific parameters that are being applied to that list of securities, not just the rating. So I'm always relying on what that Cycle Wizard found versus when I just snap something.
So what you're saying is you want to go to that tab 3, find the trade in window 3 rather than using your mouse because you want that exact trade that the wizard found.
Exactly, Stan. I want to be able to glean those historical percentage statistics and make sure that they are consistent. There's no anomaly in history that's going to be skewing what I expect the average percent move to be. I mean, if this year, when they did the IPO, it happened to be a 380% move, well, all the software is doing is taking those averages and dividing it by the number of years to give you an average. Because I rely heavily on that average to pick my target, where I expect that stock to go to. You know, we've had a great year. A lot of people made a lot of money. We're going to have a better year in 2011.
Yeah, I agree. I think next year is going to be phenomenal, and I think this first earnings report that comes out January and February is going to change a lot more people's lives next year than were changed this year. I agree with you.
But we're still in a recession. We all know it. We know people that are unemployed. And so, you know, and this is a happy time of year. Everybody likes to celebrate. A lot of people will spend money on Christmas, so it creates a lot of pressure in the market to sell after Christmas because everybody spent their money.
Hey, Gary, while you're on that chart, I don't know if you're almost wrapped up with the earnings, but you were going to do just a little bit on...
Just about ready to get into that, Stan.
Hey, all right.
That was the line I was building up to, guys. So there's a lot of pressure to sell after Christmas because everybody has spent their money. So here's some things to look for, everybody. Typically, the Qs tank the first part of the year. A 90% probability to short the Qs at the beginning of January. Matter of fact, the whole tech sector typically goes down the first part of the year. It's Microsoft. Here's an earnings trade. Typically, what does it do? 11 out of 11 years it tanks. I'm sure you guys have heard of a company called Cisco. Typically, what does it do? 11 out of 11 years it tanks. And our classic good old Google, where my son works at, and I get all sorts of inside information. What does it do? Classic short. So typically, guys, the whole tech sector goes down. So what you can do when you're done with this webinar, after Christmas, that first part of the year is go to FinViz. Go to technology. Let it load up all the tech stocks. Right? There's 929. Go to your earnings. You'd have to do it at the beginning of January. Go to your average volume, over 500,000. Price, I like stocks over 30 bucks. You guys can maybe use a little bit higher. Just like I like more trades to look at. Well, right now I guess there's only these two, Red Hat and RIM, that are coming out. Optionable on the U.S. exchanges. RIM, of course, is a Canadian company, BlackBerry. And then export that list and run it through. You know, export it in. Stan showed you how to do that. Create a new list name. Tech sector. You know, whatever you decide to call it. Run it through the Cycle Wizard. I just leave it at the default. You can also create another one like Stan showed you using shortest days of 7. longest 21. So there's some things to look for. Now, at the same time, not to be completely bearish in the market, is there's other great trades that are bullish. Netflix being one of them. Classic trade. That puppy explodes. It's a strong mover, and it's a great, great company. There's also another classic, which is Priceline. Out of 11 years, it explodes. I think it's because William Shatner's behind it. Who knows? It's a great company. Another one. Dolby Laboratories pops up 5 out of 5. Great consistency, percentage, and point movement. And there was a guy who made this trade last year. He's one of my end users. I love the guy. Actually was buying a massage chair from China, importing it. Got a little heads up on this company before their earnings came out. But it's a great, great company. Be a little careful. It had a couple of years it didn't hit. So, tech sector goes down. You guys can import a list, concentrate on that for the early part. Create the list for earnings this month, early week, and this next week. For the exploding moves with great companies like Netflix, Priceline, Dolby, Netease. So those are some things that you guys can look for in the early part of the year and set yourselves up to be able to make money right away. All right, it's 2:06 Eastern Time. You guys want to take a break?
Yeah, I think we should. I just wanted to throw in again, I mentioned it at the beginning, but there may have been some people that didn't come in. Guys, I know this feels like we're going through all of this really quick, but we had a lot of information we wanted to pack in, and we knew that you all would be receiving the DVD. So once you get the recording of this, you can rewind and watch different sections as many times as you need to. So if it feels like we're kind of going through these charts and everything too quick, we knew that was going to happen, but we figured you're getting the recording, so you can watch it as many times as you want at Christmas.
Real quick point, another thing to bring to your guys' attention, which is a very strong tool and best choice that I like to use, is the price growth. I use 6-month and 3-month charts. When I have a company that's got that strong a price growth, even though, this is back to this coach trade, it's the easy way to be able to see whether or not you want to make a trade or not. It's back to when you got this kind of strong price growth, they're like Baidu at 181%, or even like Ralph Lauren, 123%. Those are strong, strong companies with great price growth. Just because they may be overbought when you're looking at them, look at that price growth. If they're very strong, then go to that longer-term time frame to see where you can pick out your strike price. I just wanted to bring that up. Remember, these are two tools. The linear regression is a tool, and the seasonal is a tool. Now, I will tell you guys, if I don't see a trade on an earnings trade on linear regression, even looking at longer-term charts, seasonality always trumps linear regression, unless you're a real student of technical analysis and you know how to play the roles on a great, great company. Then always rely on seasonality, because seasonality will trump. Okay, that kind of wraps up my segment.
I have two things, Gary. it also helps set strike price when we're looking at these earnings plays and they're already at the top band. One, when you go back to your longer-term charts, just take a note of any previous highs.
Yes, absolutely. One of the other techniques is a great point. One of the other techniques I will do is I like profit charts, and I look at yearly. One day yearly, and everybody knows I always want to look at a macro picture first. And on profit charts, you'll be able to see what did they do on an earnings release. Did they pop up or did they tank? So you want to be able to see, and I specifically like to, you're going to look at the last 3 quarters, but I may go back as far as 5 years or 2 years and say, hey, if I'm expecting an earnings release here where it exploded in October, what did they do last October? Did they do the same thing? Well, they kind of went down. This was, you can maybe see this here.
That looks like a rundown before earnings, and then
Rundown before earnings, but guess what they did?
gaps up.
Afterwards. So, in other words, what Stan's point is very, very valid. I will go to the profit chart. You can do it off of best choice as well, guys. You know, look at a longer term. What did they do the year before at the same time? Did they pop up?
Yeah, and the other thing that I always use, whether it's an earnings play or just a regular seasonal move, to help me determine strike price is the what-if chart.
Yeah, that's, you know, I think Red Hat was coming out, so I don't know when Red Hat is actually coming out. I think it's the 15th, to be honest with you. December 21st aftermarket. Wow. Seems to do a dipsy-doodle here. The other technique, guys, is what is this doing this year? You can click on this year. Boy, this is almost identically patterning the composite. I see how it dips here, took a nice dip here, ran up, ran up. Maybe this year it's just going to continue to run, kind of level off here. So if you're looking at this particular trade, saying, hey, boy, 11 out of 11, even though it only runs to the 13th, you know, the other thing you'd want to maybe quickly look at is what does it do first of the year? Well, boy, it's a high probability that's going to go down. So if it's a strong company, you're looking at 6 months. Here's a classic example, sitting at the top of the bands. So if you're looking to do an earnings trade, what's it look like on a 2-year? Boy, 2 years, it's pretty up there too. This would be a very difficult trade for me to do. I may just pass on it. Reason is I already traded this, and I traded the October one and made money on it. So I'm pretty much done with this company until next year. But going back to Stan's point of looking at the what if and the option chain, which is a very powerful tool. There's a lot of decision-making opportunity that this particular tool gives you. A lot of people are let's see what people are loading up on the 50s on this. It's great. This is in dollar increments too. You can see where the volume is. I highlight this. I like to stay within the 1 to 3% roll. The cheaper, the better. My delta has to be over 20. In one of our previous advanced trainings, Stan went and talked about where to go to learn about historical versus implied, because you can't just say, oh, that's cheap. A lot of people ask me, well, what's rule of thumb? And I say, well, under 50% implied volatility. Well, that's true most of the time, folks, but certain companies, they could have just high volatility all the time. FFI or First Solar is one of those companies. It's got high implied volatility. So you really need to do a little bit of homework and prepare to make sure that is low. So you can go to the what if and say, well, what if that stock goes up $2? What if it goes up $2? Based on the strike price I choose, how much am I making? 48% is paltry in my book. The risk-reward there is not worth it versus the dollar I spent. I normally like to see that over 300%. You know, in other words, I've shown this example after example to a lot of the people I've trained. If a stock is, let's say, $45 and you're expecting a $5 move, this is an example right here, but if this was, let's say, a $5 move, and I'm only making 89% on a $5 move, which is over a 10% move on a $45 stock, that just tells me it's not worth it. I'm paying too much. The risk-reward isn't there. There's also a way to determine on an earnings trade which strike level is going to have the highest return. Remember, the what-if guys and gals only factors in delta. It's only factoring in based on the price of that security and the current option price. Because you can only factor in one of the Greeks in order to make these kind of charts. On an immediate pop-up, which strike level gives me the highest return? Based on what you expect the stock to do. I don't expect a $12 move. Make 1,000%. Don't just go and say, well, that's the one I want. Boy, 3,900%, so I'm going to go all the way up to the 60s. You're not factoring in the fact, what do you expect that stock historically to move based on what seasonality tells you that average percent move. This run is done. This was based on the November or October earnings. So yeah, there's a lot of great tools built right in here. Don't trade anything if your delta is under 20. Look at implied volatility. Compare it to historical. Look at what the bid and the ask is. Stay within that cheap premium, 1 to 3%. We like buying cheap options. From a mathematical standpoint, it makes sense. Use the what if button based on these earnings training, based on an immediate pop-up, based on what you historically expect the stock to move. What's giving you the better return? This one's $1.10. If it only goes up $2 and I'm paying almost half the price, I'm going to make more money on an immediate pop-up. If I expect a $2 move historically, well, gosh, that 50 strike is giving me the best bang for the buck based on an immediate move. So why should I pay $1.10 when I can pay 30 cents? Literally 1/3 the cost.
And make more money.
And make a higher return.
Less risk, more profit. That's what we like.
It is less risk, more profit. This is only for earnings trades based on an immediate gap up, folks. Keep that in mind. But it's a great tool that Stan and I use to help us determine which strike level and what's our risk reward and what's our return. Good point, Stan. Thank you.
Okay, I think you about wrapped up.
Okay. Yep, 2:18. Let's all take a break. Thanks, guys.
I'm going to take this back. Oh, I guess you have to send it back to me, Gary. Gary. There you go. Okay, guys, let's take a 5-minute break, and we'll be back in our seats in 5 minutes and get on to saving the best for last, Mr. Scott Macbeth. Guys, the break's almost over. If everyone will start making their way back to their seat, we'll start in about 1 minute. Okay, guys, we're going to start back up and go to our third and final section for today. We're very pleased to have Scott joining Gary and I for this final advanced training of the year. And Scott is our resident expert trader and very experienced with options, spent several years working for brokerages, and anytime Gary and I have a question we don't know the answer to, we go to Scott. Scott's going to cover a little bit different topic today. He's going to be talking about trading psychology and your money management. And as I said in the very beginning, this is probably where I see most people have problems with their trading. We tend to work with folks until they've got best choice down, and we teach them how to find these seasonal trades, but they then tend to have problems getting in, out of positions, putting too much into a trade, staying in a trade too long. So Scott's going to cover all of that. Some of the topics he's going to go through today. Your trading personality, very important to know. Am I a risk taker? Am I risk averse? You need to develop your trading style based on really what type of personality you are. He's going to talk about setting your trading rules and having discipline in your trading. He's going to spend some time on money management. How much of my account should I have in the market at one time? How do I diversify so that I don't get killed? How many trades should I have on? And then finally, he's going to talk about keeping a trading journal, which is very important as you go through next year. Keeping a journal of all the trades that you make. What did you do right? What did you do wrong? When you get into 2012, all you got to do is go back to your diary and say, what did I do last year on this trade? So without any further ado, Scott, I'm going to pass this off to you. If I can find Make Presenter. And you should have the little pop-up there, Scott.
Yeah, and can you hear me all right?
Yeah, you sound good.
And can you see my screen?
No, you need to click the, there you go, now we see it.
And the volume's all right?
Yeah, you're fine.
Thank you. Thank you, Gary and Stan. I'm really pleased to be here. I want to first thank the people for being here. I really respect education, and therefore I respect the attendees for taking a Saturday and being here to learn something. And I thank you very much. I want to say Merry Christmas to everybody, and I want to reiterate one thing that Gary brought up, that I too saw not one, not a few, but many life-changing stories in 2010 through Best Choice Software as regards to making money. And I'm really excited about that. I'm really excited about 2011. I can't wait to see whose life has changed coming up. I mean, is it great to be a trader? Think of the path that we're on. We're traders. We get to be our own boss, do what we love, and get paid for it. I think that's amazing. Now I'm calling this segment of the workshop Trading, the hardest way I know of to make an easy living. Subtitled, A Day in the Life of a Trader. I'm going to go through 6 topics: know thyself, rules, discipline, money management, debriefing and periodic review, and personal development. Through the years, I've found there's gold in every one of these topics. There are many things you have to do every day to make money in the market. Best Choice Software provides the groundwork. That is, what stock normally goes up or down, and approximately when. Now you need to go to work on yourself. I believe that trading, like golf, is a game played on a 6-inch field, the space between your ears. And I also have found out that trading, like in golf, if there's any effort or force or straining or struggling or trying, it's wrong. I know some attendees here whose names I will not mention, maybe just the initials, BS. How effortless was that Lulu trade that we took? And MC, who's in the audience, how effortless was that CRM trade? So all we have to do is do our homework. Best Choice Software has given you the playbook. It's like having Vince Lombardi's playbook right in front of you. You know all the plays. They're based on seasonals and extremes. But I've learned that when you embark on this life of a trader, that you actually will learn and need to learn a lot about yourself along the way. You're going to have to look at your upbringing, your attitudes, and your tolerances, and your prejudices. You're going to learn about your feelings and beliefs about money. I hope to teach you in this workshop a beginning roadmap, if you will, a small snippet of what to do. Because, in fact, there's a lot to learn. A lot. It takes most people a year or 2 or more. Mostly it's screen time. Time spent looking at the stock price movement. But as I'll encourage you later on, you will have to, or at least you should, read a lot of books by and about successful traders. I hope to give you in this workshop a starting point for a successful trader's checklist. And this is going to include paying attention to and getting to know you and rules and discipline. Now I want you to think big. I want you to dream lofty dreams. I want you to think about living your ideal life now. You have to just believe and plan and act. When I teach Best Choice Software, just the basics of Best Choice Software, I tell people it's as easy as 1, 2, 3. It's 1, the seasonals. 2, go next door to the short-term chart. Look at the candlesticks. And 3, go next door again and look at the extremes. When you get the right setup with seasonals and extremes, it's as easy as 1, 2, 3. And what I'm going to teach today is the ABCs. Attitude, belief, and commitment. I have a sign above my trading screen that says, all emotional baggage must fit in the overhead compartment. I want, when I'm trading, to have a clear mind. Before I start, I want to tell you that, did you know that if you can make just 20% a month, $10,000 becomes $1 million and only 26 months? Do the math. 2 years and 2 months, $10,000 becomes $1 million. I don't want to do the math now, but I want you to do this as a homework project. 10,000, 12,000, 14,000, 17, 26. You'll see how it grows. And I want you to keep this in the back of your mind as we go on and begin to know ourselves. 20% a month may sound like a lot. Some people, can't get 2% a year. Some people think that you're crazy if you mention 20% a month. I know it's not. You keep that in the back of your mind. Stan mentioned 1,000% profit on Netflix. It happens, ladies and gentlemen. Keep that in the back of your mind. Risk tolerance. What's yours? You have to know it. You figure it out and write it down. Watch yourself next time you're trading. Are you aggressive or timid? Are you unsure when you made the trade? You have to figure it out. Are you second-guessing your decisions? Get to know yourself. Write it down. You have to know your risk tolerance. I'm aggressive. I know myself. I'm in. And as soon as I'm in a trade, I'm immediately looking to get out. In a day, preferably.
What do you call yourself for that, Scott?
I call myself the impatient chicken. The impatient chicken. Your risk tolerance is going to come through examination of yourself. The rule to take away from this part of the module, number 1 under Know Thyself, is traders are in line with their natural personality. Next is your trading style. What is your trading style? Get to know it. Write it down. You have to know thyself. Are you in too soon on a trade? Only to see it go up one day and then retrace, as they always do, and you feel bad, and you think you've made a mistake? Or are you in too late? You missed the train. Did you get out too soon? And the stock ran to the moon afterwards? You had a double, but you could have had a 20 timeser? Or did you get out too late? Did you see a profit dwindle? You have to know your trading style. Again, I know mine. I'm an impatient chicken. I'm in, and I'm always scared. But I win. Your trading style, as you start to look at it, I've found out, has to do with your relationship with money. Your beliefs and habits formed long ago. Be aware of them next time you trade. Be aware of your moves. Write them down. Write how you felt as you're about to make a trade. The important part to take away from this number 2 module is that traders have courage. Traders have confidence. Personally, once again, I'm an impatient chicken. I'm both, but I do it. Number 3 in the Know Thyself is so important, patience. Do you have it? Patience is a virtue. My mother taught me that when I was little. Didn't mean anything back then. But it's funny how the older I got, the smarter my mother got. Patience can be learned. You better learn it if you're going to trade well. You can develop patience. How do you develop it? You practice, like any athlete or musician. You have to practice. Now, I'm sure you'll agree with me. There are plenty of times, plenty of opportunities to practice building patience in today's world. Next time you're in a traffic jam, start there. No sense getting upset. Nobody can hear you. Practice patience. When you're in the line at the supermarket, and you always chose the wrong line, didn't you? The one that was moving until you got in it, and then it stopped. Practice patience then. You will learn. You will build patience. Rules. Oh, there's those rules. We can't get away from them. Gary mentioned it. Stan mentioned it. There's rules. Number one rule, write yourself a low-risk business plan. You must do this. You're in business. You actually bought a franchise when you spent $5,000 for Best Choice Software. You had a goal in mind. You wanted to do something. You couldn't run a business without a business plan. You couldn't borrow any money from the bank if you wanted to open a Subway franchise without writing a business plan. What makes this any different? It isn't. You have to write a business plan for yourself. What are you going to do? This business plan should include the amount of money you have, how much you want, by when. It has to be time specific and it has to be written down. Then you have to write what you will give to achieve this goal. There always has to be an exchange in life. The universe works this way. Always exchange. You can get something, but you have to give something. What will you do in exchange? What will you give? Write it down. I'll tell you some things you will give. You will give time. You will give time to study. You will put in screen time. You will have pre-market preparation time. You will write down the expected move based on the seasonals. You will check out the extremes. You will know what the setup will look like when it comes around. Preparation. Practice. You will know the entry price and the exit price. Before you even enter a trade, I know my exit price. It's either going to be a profit or a loss. I know both exits. I want you to write down your uncle point. Everybody has one. If you don't have one, I'm sure you've experienced it before. It's in that wrestling game, you know, with your older brother. You know when to cry uncle. Well, don't lose all your money trading options. You have to have a stop loss. You have to know your uncle point. Write it down. That's part of your business plan. Know your T1 and your T2. Gary talked about this. Your first target. Know where you're going. You know where you're going when you're driving a car. You know that Georgia's north of Florida. You have a map when you go on a trip. You need a map on this trip. The important part to take away from this number one module of rules is traders use risk control. They know where they're going, the T1 and the T2, and they know where to land in an emergency. Before you even enter a position, you will know where to get out. Know your targets and stick to them. The setup. Know what you're looking for. What is it? A 10-20 cross? Gary showed in his segment a 10 EMA and a 20 SMA. Those are moving average lines, you know. That's an indicator. There's many indicators, ladies and gentlemen. You must know this. Best Choice Software is a tool. A tool. It is not the only tool. This is not a red light, green light, you know, black box. It's a tool to be used in conjunction with other indicators. You must find your indicators. If you don't know, call your coach, take some more training, read books. You will learn technical training. So, in the setup, you have to know what you're looking for. What is it? The MACD popped up. Gary talked about the DPO. I love it too. I use it. The DPO crossed zero on the dailies. There are many ways. Learn one and practice and prepare. And when it comes around, do it. Like the Nike commercial says, just do it. It's part of the ABCs. Action and belief. That's it. Action is necessary. Someone I talked about who was in the audience earlier, whose life was changed in the third quarter of 2010, and I mean it was changed. What's so good about these stories? I mean, they're really good. I hope sometime in the future we will do this in another webinar. We're going to bring these people forth with their permission. They're going to tell their stories. It happens, ladies and gentlemen. This man's life was changed for the good, forever. He's so happy this is going to be the best Christmas ever. He plans to do so much good with the money that he made. And you know where it started? Because I interviewed him. He's my student, a dear friend of mine now. It started with belief and action. He went to a Best Choice Users Group meeting in August, and he heard about the Google trade. And he went home and he thought about it, and he studied and studied and studied, and he called me up incessantly and bugged me, and he believed it. He believed in the Google call in October. And then he took action. He believed in the seasonality, in the extremes. I told him about strike price and volume and open interest, and he acted. That's where it all starts. So don't say maybe, or don't say this is hard, or it's difficult, or I can't do it. Banish that word can't from your vocabulary. The lesson to take away from this module is success comes in cans. ABC. Action, belief, and commitment. Discipline. Oh, here we go. Catholic school. I went to Episcopal prep schools. I've been to military school. That word discipline, oh boy, did that bother me when I was a child. Doesn't anymore. I'm very disciplined now. I love it. My military school training has come back to be a total blessing to me. You want to be a successful trader, you need to learn discipline. How do you do that? Follow a system. How do I do that? What system? Well, you already have the game. You already have Vince Lombardi's playbook with Best Choice software. You got the best playbook there is. You got seasonality. That's a system right there. You got seasonality and extremes. And when the seasonality is 100% and the extremes are set up right, down low for a long, up high for a short, that's your system. And what Gary said is true, because a lot of people have problems with this. They ask me all the time, if the stock is up high for a long, above the top yellow line, above the 90% line, on all time frames, 1 month, 3 months, 6 months, a year, but it's a seasonal long, what do I do? Gary mentioned it. Seasonality trumps. You go for the trade. Oh, it may not work, but nothing's 100% except death and taxes. The Best Choice is close second. You may lose on one trade. Don't let that scare you. You get right back up on the bike. How many times did you fall? We're trying to learn how to ride a bike. How many times did you step on the girl's toes when you were learning to dance? You keep at it. I had 100%er fail on me just this year. The Netflix short in July didn't work this year. I had puts. I got out. I know my system. I have goals. You need goals. Write them down. How do I do that? Set up your T1 and T2 based on the chart. Look at the target for the stock. Find that on a daily chart. Remember that options are different. The stock may move a certain way. The option's going to move faster, up or down, especially down. They seem to go down quickly. Tell yourself that you will wait to enter properly. Look for a low-risk entry. Enter on a breakout of a stock, or, as Gary and Stan just talked about, on favorable earnings, seasonality. You can do it the day before. Always have a stop loss.
Hey, Scott.
Yes.
This is one of the things that I've got written up on my wall. It is stalking the setup.
I like it.
I'm a big game hunter.
Yes,
I'm
sir.
not killing the squirrels along the way. I use patience and discipline, and I wait for the setup.
There you go. There's a trader who makes money and who teaches excellent trading skills, Gary Humeski. And what does he have on his wall? So use a stop loss, use a goal. On my stop loss, I use 50%. Others use 25%. Be prepared. The goal, or the learning to take away from this number 3 module in discipline is traders are disciplined. It's as simple as it is. Be prepared. It's what the Boy Scouts are all about. Married a trade? Huh. This is easy. No way. You marry people. We don't marry trades. Traders know that losing is part of the game. Never, ever wait to get even. When I was a broker, people used to pull that on me and say, Scott, you're just calling me up because you want to earn another commission. You want me to sell that stock because of commission. And I said, actually, that's not true. No, I just don't want you to lose all your money. It's not working out. Can't you see that? And I can remember to this day, from 35 years ago, a man saying to me, no, don't, I'll talk to you later. Don't bother me. I'm going to wait until I get even. And he hung up. And I watched the stock for him, even though he didn't want to talk to me afterwards. And I watched the stock continue to go down. And I know that he lost a lot of money. Never, ever wait to get even. Married to a trade? It's ridiculous. Jettison the losing trade and move on. A good, confident, experienced trader says, it never bothers me to lose. I know I'll make it right back up. I know I'll make it right back up. Ladies and gentlemen, these trades are like trains. Just wait. Set yourself a stop loss. I use 50% on the option. Some people use 25%. You know that you can lose 4 times in a row and 25%? You bought something for $1 and it's selling at 75 cents. It's selling at 75 cents. 3 times, 4 times in a row. You're getting discouraged now. You lost 4 times in a row, 25% each time. And on the 5th trade, it happened to be the Netflix trade, and he made 1,000%. Oh, okay, whatever trade, the Priceline, the Apple, the Amazon, the Google, the Baidu, Lulu. So you only had a 4-bagger. You can lose 4 times in a row, 25% stop loss on your options, and you can make it all back up and then some in spades on the one big winner. That's trading like a pro. Keep your losses small and let your winners run. The rallying cry of a losing trader is, I'll get out when I'm even. Experienced traders never bother about losing. They know they'll make it up on the next trade. Money management, important. But how do I manage my money? Well, one way to do it is a position percentage. You're going to take a position in a trade? How big a position? Traders use risk control. Traders use risk management. How? How do I do this? Have a set of rules. It goes back to that word. There's that word again. Rules. You have to have rules that you follow. This will keep you out of trouble. You have to think about yourself here. Again, this is the psychology portion of the workshop. You got to think about you. I want you to spend some time this weekend doing this. Think about you and your money and your risk profile and your stage in life and your goals in life, and write some rules down for yourself. You must do this. One of mine is no more than 10% of my capital, max 10%, max of my capital on any given trade. Now, I said max. $50,000 account, $5,000 on a trade. Some people think this is small. $5,000. Oh, I know the Google's going to go whatever. I'm going to do $25,000 of a $50,000 account. You're nuts. Don't do that, because 10% is good enough on a $50,000 account. When you do just $5,000, when the Google trade does work, or Netflix or Priceline or Amazon or Apple or Lulu or X, you get a 2-bagger, or inside the park home run, or how about 1,000% on Netflix, so that $5,000 can become 50 again. Nothing wrong with baby steps. Traders use risk control, minus 10%, max. Smaller accounts, unfortunately, you have to take more risk. Larger accounts, $1 million account, 10%, maybe too much. Some people think that's too high. I agree. When you get up into the millions, you can go down. I said 10% max. You can go down when you're in the millions. You have $1 million account here, you can use 7%. No more than 7% of your capital on any one trade. That's $70,000. Know your risk tolerances and trade accordingly. There's nothing wrong with baby steps. As I mentioned before, unfortunately, smaller accounts require more risk. What can you do with $1,000? Not much. $1,000 account, you're supposed to listen to Scott and do only 10% of it, $100 on each trade? No. Smaller accounts, you have to step out on the dance floor. Smaller accounts require more risk. $10,000 account, the 10% rule, $1,000 in each trade. Yeah, you can do that. The thing to take away from this first module is traders use risk management. Total equity risk. It's different than position percentage. Total equity risk is up to you. You have to know yourself again. You have to know what's comfortable. It's human nature to do what's comfortable. Don't be lulled to sleep. You have to have a game plan. I use, once again, no more than 10%. I like that 10% figure of my total equity. If I have $550,000, it'll be just $50,000 somewhere. And some people think that's high. $50,000 account, that's $5,000. The big winners will more than reward you. You have the 2-baggers and the 10 times. So go small on total equity risk. One of the things that when you don't have money and you need to get it, you have the $1,000 account, you really need to study hard, and prayer helps, and you know, best choice seasonality, of course. But if your first foray into the dance floor, you get knocked down, you might get blown up in a $1,000 account. It happens in trading. You have to go find another $1,000 and try it again. But when you have money, you can keep it down because you will be rewarded by the big winners, and your losers will be cut in half and jettisoned immediately. You lose something, out. The important thing to take away from this number 2 module in money management is, and I know this for a fact because I was on the floor and I watched pros trade, pros don't overposition. All in, this nonsense about I'm going all in, that's for late night TV on those poker shows where you see the people on TV with the poker, they push it. It's very impressive looking, completely ridiculous, or you know, not sane to do with your own money. When they push all the chips into the center of the table and confidently announce I'm going all in, ridiculous. I'm telling you, pros don't do that. They never go all in. As a matter of fact, quick story, true story, I was in Paul Tudor Jones' office. Those of you who don't know him, you should read the book by him, and on the Best Choice software, one of the white things that pops up is some quotes that Sonny put in there, I believe, and one of them is from Paul Tudor Jones. Well, I was in his office. I met him when I was a 20-year-old kid, you know, for being the options and commodity coordinator of Merrill Lynch in Palm Springs, California, way back in the 70s. They sent us to Chicago for training. I stayed for 6 weeks in the Drake Hotel. Thank you very much. First time I ever saw a phone in the bathroom. Now I know what that's for. And one day they took us down to Paul Tudor Jones' office so that we could watch a pro trade. And there was like 7 of us in his office at once. He wouldn't know me from Adam, but I shook his hand, but he wouldn't remember me. But while I was in there, the point is I was looking around his office, and I noticed, this is a true story, that he has a sign over his trading computer that says, big positions cause big problems. Keep that in mind for your equity risk. The lesson to take away from this module number 2 in money management is big positions cause big problems. Number 3 in money management, scale in, scale out. One way to keep the risk down, both in your current trade and your total equity, is to scale. Remember I said pros don't go all in, so you got to learn scaling. When you see a proper setup, when you have the Google trade coming up in whatever, there's about 4 or 5 of them per year, Netflix Priceline, when you see the seasonality, and then you go next door and look at the extremes, and it's just all set up fine, you know, for long, you know, the thing is down below the bottom yellow line on the first day, you just look at it. And the second day that it stays down, it goes lower, you start to position yourself. I sometimes wait till the 3rd day down. And whatever my total package is, we used to call it, well, we still do, a total package, whatever you want, whatever your position you're going to take, 10 contracts, 100, that's called your package. Whatever your total package is, you only put in a third of it when on the first or third day down under the bottom yellow line, because you don't know, maybe it's going to go lower. We don't really know the future. We only know the behavior of the past based on seasonality. But these things can spend a lot of time below the bottom yellow line or above the top yellow line. I've seen them take up to a month. Some of them defy gravity. I remember when True Religion stayed above the top yellow line, you thought it would be being held up by some otherworldly force. It lasted a month up there. So we scale in. First dip down below the bottom yellow line on a long, put in 1/3. It stays down there, or it starts to go up. You get the classic sign of a higher low. I put in a third more of my total package. The thing goes back down because it was the fake out, not the breakout. It goes sideways for a while. It starts up again. It breaks the bottom yellow line, or my 10-20 cross happens. I put in the third of the third of my total package. I'm in. Pros never go all in. Don't you do it either. Scale and be. As soon as I'm in, I'm ready to abort. Just like a good pilot, I'm always looking for a place to land. You have to know your exit point when you get in. And you have to know the reason why you got in. There has to be a compelling reason to take the trade. And when it goes up, then I scale out. When it goes from the bottom yellow line and it hits the middle line, I start to take profits. Impatient chicken here takes profits. Rule number 1 in my book of rules. Can't go broke taking a profit. Bernard Baruch said that. Go read his book. Please take profits. Daily debriefing. It sounds like the Army or something, doesn't it? Or the CIA. Oh, why do military types and the CIA and the FBI and the intelligence people, why do they debrief their people? Because it's important. You want to be a good trader? You got to learn. You're here today on a Saturday, which I respect you immensely for. And you're going to continue your education your whole life. It never ends. And one of the things that you should do is a daily debriefing of yourself. It doesn't have to be fancy. It doesn't have to take a long time. You're sitting in your office, your sanctuary, after the trading day, and just spend 5 more minutes in your spiral notebook. I teach every one of my students to keep a simple spiral notebook and write in it daily. It doesn't have to be Dear Diary, just a daily debriefing. What did you do today? Did you follow your system? What did you do right? What did you do wrong? Easy. Write down your trades, the entry price. What did you see? Why did you do it? What was your T1 and T2 and your stop? What happened? Make note of general current market conditions. Look at what you saw or what you thought you saw. Seasonality concur? Did the extremes concur? How much and how long? Would you look at the 1 month, the 3 month, or the 6 month? Why did you do this trade? There must be a compelling reason to make a trade. We're not gambling here. There must be a compelling reason. This is a business. What was the compelling reason? The 10 crossed the 20? That's a reason. The DPO crossed the 0 line? That's a reason. The important lesson to take away from number 1 under 5 debriefing is develop and use a simple trade overview system. Number 2, periodic review. You have to do a periodic review. You have to review weekly your goals and your achievement towards them. Am I getting there? How am I doing? I do this. How much did I make last week? $2,000. My goal is $10,000 a month. I'm on track. How much did you make? Or what mistakes did you make that you won't repeat? Did you follow your low-risk business plan? i.e., did you only enter when the 1 month extreme is below the 10%? And then annually, ladies and gentlemen, please do this. Annually, I take a self-inventory. I do it on my birthday. It's a wonderful time. I get to look back and see how I'm doing mentally and physically, monetarily, with my family. Annually, take a self-inventory. That's a periodic review. Keep a journal of all your trades. Keep it daily. You're going to keep it all your life. It's a wonderful thing. I have lots of my Spiral notebooks, and I named them 2011 and 2010, and I have them back to 1979. Got them all right here in the office. Keep a daily journal. What did you do right? What did you do wrong? And take responsibility for your past and your present, and visualize your future. You have to believe that something good is coming your way. It's part of the ABCs: action, belief, and commitment. There's a way. What to take away from that is keep a journal. Personal development, so important. Now listen, personal development and growth is key. Number one is to have a balanced life. I'm going to ask a hard question here. Are you addicted to trading? Don't be. You must balance family and a hobby. Do you have a hobby? Get one. And chores? Do you think chores are boring? No, they're part of life. Gladly and willingly do them. You're happy to be alive and to make money. You have to balance your relationships. You can't just trade all the time. You must have a balanced life. You have to exercise. Now I'm going to sound like, how many times have you heard that? You have to exercise. The important part to take away from module number 1 here of personal development is you must exercise. Write it down. You must. If I could run roughshod over each and every one of you like a Catholic school teacher, I would. I call Gary up every morning, make sure he's out there exercising, don't I, Gary?
Yepper, man.
That's a fact. You must exercise at least 20 minutes. Give him 20 minutes. I want to say 30, but go ahead and give him 20. I'm going to hammer on this because you have to. You need oxygen in your body. You need the blood flow. You need to be alert and clear of mind and focused. If you're going to be a good trader, we're talking about trading here, yes, still, you have to be clear of body, mind, and spirit. And your office, your trading environment is a sanctuary. Don't forget the sign over my trading screen that I talked about in the beginning. All emotional baggage must fit in the overhead compartment. You have to have a good night's sleep, and you have to properly have nutrition, and you have to exercise. You have to be ready, focused for trading. It's a business. And there's somebody on the other side that is against you. We have seasonality on our side, though, so we got the battle half won. I mean, you got Vince Lombardi's playbook. All you have to do is execute. Can you run and tackle and pass? Yes, we can. We got Vince Lombardi's playbook. I mean, how can you go wrong? Being out of the market, really important. Have you ever done it? Well, do it. Do it this year. Being out of the market means being totally out of the market. I don't mean peeking at the journal or looking on your screen or looking on your BlackBerry. Try it for a week. Be totally out of the market. When you're on vacation, don't be looking at the stock prices. I used to take 2 months off. I've been pulled back into service because I love to teach. But I used to take the month of December and the month of August off. I'm going to get back to doing that. I'm taking 2 months off. I always take 1 month off now in August. And when I'm off, I'm off. When I'm in Jamaica, I'm not looking at Google. So do it. Give it a rest. See what life is like. Make a bucket list. And if you don't know what that is, go rent the movie, The Bucket List. Do this. Make a bucket list and achieve it. Learn something new. Please write this down. Learn something new. Try to learn something new each day and give something. This is Christmas. I want to say Merry Christmas again to everybody. It's important to me. Christmas is a time of joy and reflection and generosity. Be happy for the life-changing events the best choice in being in the market offers you. And then you take some time off. Even if it's just for a day, you got to be away. Personal growth and education. Personal growth and development is the key, ladies and gentlemen, and it never ends. Take it seriously. Think about you. Take care of you. Love what you do. And remember, it's all about you. So take care. And I'm finished with my portion. I hope that helps.
One little caveat, if I may, Scott.
Please.
Everybody, a trader's goal, paradoxically, is not to make money.
That's so true.
Goal is to trade well, follow your system, have a balance in life, prepare. You know, one of the greatest tools that we've all, and why we're here, is because of Best Choice. You know, to be a successful trader, you need to know with some modicum of probability what's up ahead of you. And that's what seasonality and Best Choice does. Using this tool properly, guys, I'll tell you, it humbles me on some of the success I've seen some of the people on this call have had, and I mean truly life-changing events. So remember, that your goal paradoxically is not, don't focus on the money. Focus on trading well. And when you trade right, money will almost follow as an afterthought. Stan, why don't you wrap this up, man?
All right. Well, yeah, we went a little bit over, but I'm very impressed with the fact that we fit all of that in. And as I said before, guys, I know that it probably seems like blinding speed, but you're going to get the DVD in a week or two, and you'll have the opportunity to go back and take more detailed notes and so forth. And I especially hope that you go back and review what Scott just did, because every single one of those points that he made, and he probably could have done the whole 3 hours and expanded on it, but every single point he made, there's a nugget of gold in there. Every bit of that is critical if you're going to be a successful trader. Let me try and take this back, Scott, from you. Okay. Well, I'm going to go ahead and wrap it up and not drag on too long. One thing I had planned on doing at the closing here was, first of all, as Scott said, I'm impressed that all of you are here on a Saturday afternoon to continue your education. Scott made the point several times, this is a business, and you need to treat it like a business. I think it was Zig Ziglar who said, if you treat your business like a hobby, you're going to earn a hobby income. And one of the things that goes along with that is, you know, the business plan and so forth, but I think the most critical thing is education. One of the sayings that I like the most is, those who continue to learn continue to earn. And as Scott said, it's a never-ending process. Learning the most you can about trading, about the markets, about technical indicators, about yourself. What's your trading personality? Because if you're trading a different style than your personality, you're probably not having very much luck. And I just wanted to throw up one picture just to show you guys that we put our money where our mouth is. I took a picture last night. These are the books and DVD seminars that I personally have invested. Notice I didn't say bought or purchased. I'm investing in my own business. This is what I have invested in myself and my own education just in the past 2 months. And I do this every month. And there are a lot of great sites out there. I personally like Traders Library. It's not necessarily an endorsement, but they've got pretty much any trading guru book, DVD, seminar. And I just wanted to show you the reason we can teach this is because we're learning it from someone else, from the people who have come before us and been successful. And if you want to be successful, continue to learn. Now, the last thing I want to say here is, in addition to getting the recording of today on the video, I have asked both Scott and Gary to just type up like a one-page list of their top 5 trading rules. As Scott said, you've got to have a business plan, and part of that business plan are your trading rules. What's going to take that emotion out of trading for you is having a set of rules and following those rules. And so we're going to collect those, and I'm going to put all 3 of those, each of our top 5 trading rules for ourselves, as a Word doc on the same disk with the video. So when you first get the disk, you can print those out. And I'm going to guess, I haven't seen their list yet, but I'm going to guess that maybe 1 or 2 of our top 5 will be the same. But I'm also going to bet that 2 or 3 on each of our list will be different. And why is that? Because we each have a different personality, and we each know our personality, and we develop our rules in trading based on our own personality. All right, guys, I'm going to go ahead and end the recording here. We've kind of gone a little bit over, but not as much as I had dreaded. But we packed a lot into this. Watch the DVD over and over and over when you get it, because I know we went through this real quick.